Hi, good afternoon, everyone, and thanks for tuning in to during our lunchtime today to join our webinar titled "Hanging in Limbo." So, as the title suggests, I believe fixed income investors currently might be feeling like we're in a limbo or perhaps a standstill state with the regards to the current interest rate environment. So, what can we do at this current juncture to maximize on our fixed income portfolio? So today we have with us our Phillips fixed income desk as well as myself, who will be conducting this webinar. So, and as always, just a disclaimer that this is a sharing session and would just be for educational purposes and not to be treated as financial advice. So all investors and advisors are still supposed to do their own duty before making any investment decisions. So let me quickly run through briefly on what we'll be covering for today. So first, we'll be starting off with a quick recap on the Singapore fixed income market flow during the first half of this year. Then I'll move on to quickly run through on the current interest rate environment and how will this movement on interest rate impact our government securities. And also lastly, I'll do some sharing on some of the few bond ideas to perhaps spur some interest before concluding the session with Q&A. So without further ado, let's look at the bonds volume in Singapore for the first half of this year. So, in the first half of this year, we've seen a picked up in bond volumes from the previous, I believe it was 17 to 26 corporate bonds with the size, sorry, yeah, uh, picked up from the 17 to 26 issuance during the first half of this year. And these issuances are size greater than 100 million and are denominated in our local Sing dollar currency. And also, as opposed to the previous year where most of the issuances were saturated by banks or financial institution, which, if I'm not mistaken, I think it was approximately 7 to 80% of them, of the new issuances were issued by banks and FIs. This time around, there were a good mix of issuances coming from the REITs, property, as well as the bank issuers themselves. So out of these 26 bond issuances, approximately around 8.29 billion was raised in the first half of this year. So, if you were to take a look at this chart on this slide, it reflects the amount raised for the previous 2 years as well as this year. And I know that although I did say that the bond issuances picked up this year, but why did first half of this year reflected a reduction in the amount being raised? The reason for this reduction would be because although we might have a much clearer indication on where interest rate might move in the second half of this year or perhaps the next year, but as of current, interest rates still remains relatively elevated. Therefore, issuers may be apprehensive in issuing large volumes at this juncture, as they might not want to lock in a larger proportion of their debts when interest rates are still relatively high, therefore translating to a lower amount being raised in the first half of this year. Yeah, moving on to interest rate movements and expectations. So yeah, this is the latest FOMC meeting. Which happened, I believe 2 weeks ago, on the 12th of June. So the Federal Reserve has stated that the economics activity are aligned with the Dow mandate once again, but because of the inflationary data pointers are still elevated, hence they have decided to maintain their rates for the seventh consecutive time at a range of 5.25 to 5.5%, as they have stated that they have not attained the confidence that they are seeking, and it is still not appropriate to discuss any rate cuts at this juncture. And in terms of guidance, if you shift your attention to the left of the screen, this is the latest dot plot that was released just 2 weeks ago. And as you can see, the Federal Reserve have shifted its guidance from a probable 325 basis point cut to happen this year back in March to only one perhaps in December this year, as they have penned down the mean interest rate projection for 2024 to be at 5.1%, bumping up from the previous 4.6% that was released back in March. So, before the meeting, I believe that the worry of cuts happening this year might be taken off the table, since, the first quarter of this year, inflationary data pointers have come in slightly above market expectation, but have slowed down gradually since the last month reading, with, I believe, May's total and core CPI coming in at 3.27 and 3.42%, and total and core PCE coming in at 2.65 and 2.75 respectively. However, despite the more positive data pointers coming in the latest reading, I believe, during the conference call, during the conference, Chairman Powell has stated that the recent monthly reading have eased somewhat, but it's still not yet enough to instill the greater confidence that they are looking for, that inflation is indeed returning sustainably towards their 2% targeted range. So with that, I believe that this has instilled some comfort lah, for our fixed income investors, that the possibility for rates to falter is still present, but the Fed will be taking a more conservative approach, as they do not wish to make a premature decision that may unwind the tightening effort they have put in place previously. Yeah. So moving on, this is just an overview on the CPI and PCE graph. And as you can see in general, inflation is indeed trending down despite the small uptick in the first quarter of this year. But inflation still remains relatively stickier than expected. So, before inflation can reach the federal targeted range of 2%, I believe it still have to show month-over-month decline before this can provide more confidence for the Federal Reserve to give the confirmation on when do they want to do the cut. Yeah. So this is also the Fed funds future curve, which indicates what the market is expecting interest rate to trend for this year. So in this graph, you're able to see two lines, one in a dark blue and the other one in orange. So the dark blue was the expectation that the market has made, at the start of this year during the first FOMC meeting. And during that period, market was rather optimistic and was pricing in for rates to fall approximately 150 basis points for this year, which is approximately around 6 basis point cuts. And the cuts to come in as early as March this year. However, now that we are in the month of June, heading into July, we know that wasn't the case. If you were to look at the orange line, this is the latest market expectation right after the June's meeting. The market is still slightly optimistic and pricing in possible 2 rate cuts to happen this year, with the first coming in as early as September, just before the US presidential election. So, with that, the market has become more prudent with the expectation and tuned down from their 6 to only 2 rate cuts to happen this year, but still 25 basis point higher than what the Federal Reserve have indicated in their projections. But the question is, will rates continue to pull higher this year? I personally think that it will be unlikely, as there were multiple instances the members have previously stated that they are comfortable with the current range, and that they are in that they are in right now. And if inflation were to continue to stagnate, then I believe that the Federal would just continue to hold the current rate steady for a longer period of time to keep a watch on the data. But with that said, anything could happen, and possibility of interest rates trending even higher is still possible if there's a black swan event such as an escalation of geopolitical tension were to happen. Yep. So how will this impact our local government securities? As you all know, bond yields move in tandem with interest rates. Hence, if interest rates are projected to hover for a little longer, then similarly, we should experience the yields of our government securities to hover at the current level for a little more as well, until at least when the rate starts to show signs of improvement. So if you were to look at this chart, which is the yield curve for our 6 months T-bill, it's true that gone are the good old days where, you can get percentage points like 4.4% for 6 months duration. But as you can see, for yields, for our 6 months yields, they have been consistently been between the range of 3.6 to 3.8%, with the latest cutting off at 3.74 just last Thursday. So, thus we believe that the yields for our 6 months T-bill will still continue to be range bound within this range, at least until the end of this year, or when there's a distinct indication from the Federal Reserve that a rate cut is imminent and going to happen. Only then will we experience a reduction in yield for fixed income notes. With the next available window, I believe, next window available for subscription, it will be open tomorrow, and the cutoff yield would most likely fall within this range as well. So yep. Additionally, I believe some investors would like to compare between T-bills and fixed deposit. So this is just a rough overview on the comparison between our 6 months T-bill and our local fixed deposits. So I mean, DBS, OCBC, and UOB, their fixed D are still currently offering at a much lower rate as compared to what our government treasury bills can generate for approximately similar duration. But however, I believe that our 6 months T-bills as well as our 1 year are still giving approximately a percentage point higher, 1% higher. Hence, this would be it would be wise for investors to park their short-term fund into our local government treasury bills instead of our local banks fixed deposits. Yeah. One question I would believe that some people might raise would also be, what about the fixed D for overseas banks? Yeah. For fixed Ds for overseas banks, I believe that some of them might be giving slightly higher competitive yields as compared to what our local banks are providing. However, do take note that if you were to deposit into a overseas bank, then you are taking the risk of the overseas bank itself rather than our local banks itself. That's why for this table, I like to do an apple to apple, local to local comparison. Hence, I put in the local banks instead of overseas banks. Yep. So this is just a slide to show that right now both the Singapore and US yield curve are still inverted, which means that shorter dated bonds are still generating a higher yield as compared to the longer dated ones. Thus, I believe that once the cut starts to take place, the curves will start to flatten, start to slowly flatten out and turning back to normalcy, which is upward slope, an upward sloping one. Yep. So yeah, in general, I believe that 6 months and 1 year are still relatively high. Then you can start to see the flattening coming in from the 5 to 10 year range. Then the picking up would be from the 10 year to 20 year range onwards. Yep. Yep. So moving on, I'll be sharing on some of the bond ideas for this seminar. And the first bond that we'll be sharing would be CapitaLand Escort, 3.07% perpetual. So this perpetual was announced back in 23rd June 2015. It gives a coupon rate of 3.07 and it has a reset date on 30th June 2025 and every 5 years thereafter, which gives approximately 1 year to next refix. And this perpetuals also carry a reset of 5 years SOR plus an initial spread of 2.5%. So an indicative pricing for this perpetual that is currently trading on the market would be 98, which gives potential investors opportunity of attaining a 5.116%. So why do we choose why do we say that this CapitaLand Escort 3.07 looks interesting? Is because that first of all, you have to know that SOR, later I'll touch a little bit, but SOR has already have the SOR benchmark has already ceased since 30th of June last year, and they're proceeding to SORA rate already. Coming, I believe 2 years ago, all new issuances are benchmarking against SORA rate. So this is just one thing that later I'll touch a little bit on why do I think that SOR perpetuals have a higher tendency. So if let's say we were to take out this SOR portion away and replace it with 5 year SORA. So if comes 30th June 2025, if let's say the issuer do not redeem these perpetual bonds, then these 3.07 perpetuals will have to be resetted at a rate of the 5 year, at the current 5 year SORA rate, plus the initial spread of 2.5%. So given that, let's say, if we were to be prudent and saying that interest rate to dip in the next year, and it dip for 5 year SORA, it could land around 2.5%. So for example, come 30th June next year and issue the CapitaLand Escort choose not to redeem these perpetuals, then these perpetuals will have to be resetted at, let's say, we take the prudent 2.5% plus the initial spread of 2.5%, you'll be getting the new coupon rate of 5%. So for this 5%, issuers will have to lock in for another 5 years before the next reset can come in. Hence, I believe this will be expensive for CapitaLand Escort to lock in for another 5 more years when interest rate starts to dip in the following years to come. Therefore, to me, it seems that Escort 3.07 might be something to worthwhile to take a look, considering that it's trading below par right now. So the second aspect that I like about Escort is because they marry stability and growth together. So they have a revenue two-pronged approach whereby one comes from their variable variable sector, and the other one comes from their stability sector. So in the first quarter of 2024, I mean, CapitaLand Escort gross profit went up by 7% year on year, and their revenue per available unit went up by 6%, which is 135. And this is in line with their pre-COVID levels, contributed by stronger operations performance and higher room rates. And this is to taking into consideration that we're stripping out the new acquisition as well as their divestment aside. So apple to apple comparison. And also here comes the two-pronged approach, which is their longer stay properties as well as their hospitality segment. So for their stability sector, which is their longer stay properties, mainly their rental housing properties, they currently have more than 95% occupancy, while their second stability income, which is their student accommodations standards at Columbia, has more than 90% student occupancy for the academic year of this year already. And this has achieved a rental growth of approximately 5.5% year on year. Therefore, it shows that their properties have a demand for it. And if you to zoom into their credit health, CapitaLand Escort has a prudent credit health, and their gearing recently came down from 38.7 in their first quarter of 23 last year to 37.7 to 37.7% in the first quarter of this year. And the management has guided to for their gearing to expect to remain below 40% range. And if we look at their liquidity buffer, currently Escort has a liquidity buffer of 1.2 billion, and this is more than adequate to meet their near-term debt obligation all the way to 2026. And remember, I said that this perpetual refixing and callable next year, which is 2025. So this falls under the window that they are able to meet their debt obligations. Hence, this provides me with much more confidence that if there comes an opportunity that if Escort can choose to redeem, then they have the ability to do so. Then even a further boost of confidence would be CapitaLand Escort has a Fitch rating of BBB, and this is up from the BBB minus back in May 2023 last year. Yep. Sorry. Yeah. So this is a rather interesting slide, which are those perpetuals that are callable this year and early next year with reset rates based on Singapore swap offer rate, or SOR in short. So this was the SOR that I was talking about previously, because I mean like I mentioned, the usage of SOR as a benchmark rate have ceased on 30th June last year, and currently all new issuances now with the reset rate will be based on Singapore overnight rate average, which is the SORA rate in short. But I mean, according to Association of Bank in Singapore, or ABS in short, who are the ones the ABS are the ones who are the ones that are structuring the guidelines of the transition from SOR to SORA. So according to them, in order for perpetuals to transition from the legacy rate, which is the SOR, to SORA, which is the new borrowing benchmark rate, issuers will have to go through with a consent of solicitation for the new proposed rate. And I mean, during the implementation, the discussion with regards to the transitioning, many industries have sought for a redemption. I mean, many industries have voiced out that they have sought for prefer a redemption and then reissuing newer notes with the new benchmark, rather than to roll over by doing a consent of solicitation. Yeah. Hence, this is a list of perpetual that are callable this year and the start of next year with the embedded legacy rate. So I believe that this might be of interest for investors who are currently holding onto any of these bonds, or perhaps have the opportunity to pick them up when they are trading below par in the secondary market, sorry. And also, my second thesis on why I believe that these perpetuals have a higher tendency of redemption would be because currently, as I mentioned, interest rates are still relatively elevated, and the 5-year SORA rate is approximately around the range of 2.9% or perhaps 3. Hence, if this issuer were to choose not to redeem these bonds, almost all of them will have to be resetted to the mid 5 or 6% range. And keeping in mind that the new coupon rate after the reset will have to be locked in for another 5 more years before the next reset can take place. Therefore, I mean, this might be an expensive decision for the issuer in years to come when interest rate starts to dip further. But on a side note, although most companies have voiced for their redemption, voice out that they will prefer a redemption, a rollover may still happen if the issuer chooses to do so. So, I mean, the area shaded in green will be those that have already been called in the first quarter of this year, while those in the yellow and the orange will be callable this and early next year, respectively. And currently, I mean, these are the ones that are still outstanding and available in the market. So, I mean, you may also wonder why is hotel properties 4.4% in the yellow region being quoted in green? Well, it's because I believe earlier last month during the start of May, hotel properties have issued a new issuance, sorry, which is their 5.1% notes with a 5 years maturity. And during that issuance, the issuer have stated that the amount raised in the 5.1 new issuance, a portion of it will be used for the redemption for the current outstanding 4.4% perpetual notes. Hence, that is the reason why I've highlighted it in green, because I mean, with that sentence, I believe that this will boost the confidence of those that are currently holding on to the 4.4% notes, that there is much more certainty in terms of the redemption for these perpetual notes. Yeah, so come to the conclusion. Right now, we believe that rates are still expected to remain elevated for a slightly longer period, all the way until fourth quarter of this year, because I mean the Federal Reserve have time after time said that they're still trying to garner more confidence in terms of the data pointers coming in. So I believe that from now all the way to the end of this year, we should give them approximately around 6 months room of waiting time to monitor if inflation do indeed starts to trend down further. I believe this 6 months would be a comfortable range to give them the confidence that they need in order to call their first decision. So in terms of short-term play, I believe short-term treasury notes can still be viable, and investors can still maximize on the inverted yield curve and capitalize on it in terms of short-term investment. And I believe right now, like I've mentioned, our 6 months will be around 3.6 to 3.8 range. If I'm not mistaken, I believe US Treasury notes at this current juncture is still giving a rather attractive of around 5.3% range. So this is rather attractive in terms of something that is relatively risk-free and such a short duration. But I mean, despite these short duration bonds, don't take note of a reinvestment risk, as because I mean, if let's say Fed were to cut at the end of this year, then I mean, you're viable, you're volatile to whatever rate that will be issued at the end of this year and it could be lower than what you are getting as of current. Then lastly, I'll say that perhaps now will be a good time to look into adding some durations into our portfolio and lock in the rates. Because what do I mean by that is because that right now, because interest rates are still relatively high, and issuers will have to issue bonds at a slightly higher coupon rate. Hence, I mean, right now for newer issuances, I believe that it could be rather attractive to lock in those 3 year, 5 years, 7 years duration in years to come. So when you're locking in a slightly higher rate, coupon rate for a similar issuer, then as interest rate starts to dip in the future in the future years, then these bond prices will start to appreciate because the coupon rate they are getting from the same issuer are slightly higher than what they are able to issue when interest rates are slightly lower as compared to the current juncture. Yep. And for those who are interested in US Treasuries, right now, I believe our bond desk, PhillipCapital, are providing US Treasury bills in our platform. So the durations you can look at are usually around 1 year and beyond. So for those who are interested in investing in US Treasuries, do take note that minimum investment sum is 200,000, and you can apply through our platform itself. Yep. With that, I'll conclude my presentations for today. So this is just a slide on our Phillip Capital Bonds Telegram group for those who are interested to join. So for those who have Telegram, do scan and join in, because this will be our very first avenue whereby if there's any new issuances or fixed income news that is related to the market, this will be the first place that we will post all these informations to our investors and clients. Then subsequently, it will be put onto our website. Then, if not, we'll blast them out through email chain. But for those who would like to get first-hand notification on informations on new issuances, this is the place to go to, right? And as I said, previously for trading of bonds in Poem, it was only applicable in our website, web platform. However, I believe start of this year, we have implemented bonds trading into our P3 platform as well, P3 application. So for those who have downloaded our Poem Stream mobile application, right now, for those bond investors who wish to trade bonds with us, they are also able to do it at their fingertips as right now. However, do note that bond transactions are only limited to accredited investors, yeah, for purchasers or express interest in new issuances. Yep. So yeah, with that, I'd like to move on to question and answers if there are any. Thank you.